Well, let's put up our first chart, Casey, if you could, and some examples of reasons not to invest. If you're seeing us on the video channel, you think about that long list. And what we're seeing here on this chart, John, is going back to 1999 and the time span all the way through 2021. And 1999 was what? The Y2K fear, right? Remember, everybody thought when the calendar turned on January 1 of 2000, the computers were going to take over and shut down the world, right?
Yep.
And everybody freaked out over that. And that could have been, it's not the same crisis of the day or crisis du jour, as Janet likes to call it, as we're facing right now with recessions and interest rates and high inflation. But if you would have taken an approach to, I'm not going to be in the market right now because things are uncertain. Well, follow that line from 1999 and the event of Y2K over to the cumulative return of the S&P 500 since that time. So that's 22 years, roughly, 21, 22 years. It is up cumulatively 467% since that time. And think about how you may have, if you lived through that time, and I did. I actually got married that year. So I remember just starting my family, or beginning to start my family right there with all of that fear and uncertainty. I remember how it felt. It was very real. But if I let my emotions drive my investment decisions, and again, not able to separate that good investments don't always equal good feelings, I might have parked that money and with at least some of it never gotten back in and missed out on the upward ride of 467%.
I'm going to ask Casey to put that chart back up one more time because I want to point out something very critical here. Notice that where the chart starts in 1999 and goes all the way to 2021, guess what? Every year there is a reason not to invest. So if you're out there today and you are thinking about, or maybe you already have, decided you're going to put off retirement till things settle down, I want to ask you very earnestly, when is that going to be? If you look at history, there's always some reason not to move forward. And I will guarantee this to you. History will repeat itself. Going into the future, there will always be some reason not to move forward. So when will it be okay for you to jump back in or to move forward? You can't base it on the events of the day, I think is the key part that I would point out here, Scott.
Yeah, and I think the other part of that, John, when you talk about the clients or the potential clients that Anna is talking to, and some of them are resistant to doing anything right now, it may be related to, I don't want to be in the market because of the uncertainty, and I think we've dispelled that. But I think the other reason, too, is a concern over I don't want to touch anything the way it is right now because I'm in XYZ investment and it's down 20%, and I don't want to get out of XYZ investment while it's down 20%. And I think the genesis of that's a good idea. That's good. I think the thing that we need to talk to people about is, when you begin to talk about reshuffling the deck investment-wise, it doesn't mean that you won't ride that investment up just like you rode the other one down.
Yeah, if you think about this sort of an analogy of a couple of elevators running together in a building. In our building that we're in right now, we have two elevators side by side that go up and down to carry people up to the 7th floor and all the way down to the 1st floor. So if you go down in one elevator and the other elevator follows you down, and you get off on a floor and get back on this elevator and ride this elevator back up, doesn't matter which elevator you were in as long as you go back up. The key here is this. If you sell and get out of the market when the market is down, Tim, that's probably not a great move. But if you sell and get back into the market because you're moving from, let's say, a 401k to an IRA, then you're basically exchanging a market-based investment for a market-based investment, and you have just as much potential on the upside in one as you did in the one that you were in before.
Yeah, things just continue as they are. There might be a brief time when the money's in transit, but that's about it. But yeah, there's a lot of good cases for, maybe making a transition from one investment to another, to a different asset class or something like that, really helps round out your portfolio. 401ks are great accumulating tools, but most 401k plans are very limited in what they offer as far as investments go. And when you're in an IRA, really the whole universe is your investment pool at that time. You've got so many different options. And so being able to get out of one 401k, and really it's all according to the plan. The plan really needs to be built, and we need to know what exactly, looking forward, what your goals are to make sure that we have the investments properly allocated.
And that's the thing too, Tim. You just hit on it. The plan. That we can talk about the investment part of that, of moving money from a 401k to an IRA. But the other thing is if you're staying in that 401k, you're likely not getting advice, and you're likely not getting a plan.